Well, welcome everyone to the 2023 third quarter investment review by Nelson Capital Management. I'm Brooks Nelson, founder of the firm. With me are Darcy Nelson Smoot, Steve Philpott, and Evan Nelson. We're going to cover a variety of things today. As you have questions, if you would so kindly put them into the Q&A box at the bottom of the screen, and at the end we'll make sure that we address all of the questions that you raise. So today's presentation, Evan will start with a market review. Darcy will follow with the discussion about equity valuations, earnings, inflation, and labor. Steve will talk about rates and risks, and then we'll conclude. So with no further ado, I'll pass the spotlight to Evan.
Thanks, Brooks. We're going to start today by looking at asset class returns. In gold, we have third quarter returns, and in blue, we have year-to-date returns. On the left, there are two bond indices, the Barclays Municipal and Barclays Intermediate Government Credit, which have been flat to down on the year. Bond prices move inversely to yields, and the rapid rise in yields this year has weighed on returns. Small cap refers to small company stocks, which have also underperformed this year. Small companies generally need to borrow capital to continue to grow, as they do not have the same proven revenue streams of larger companies. Rising rates means that it's become more expensive for them to access this capital, which has lowered their bottom lines. Emerging markets have not fared any better. China is the largest country in the emerging market index, and many speculated that coming out of COVID lockdowns, China would return to growth. However, unemployment in the youth unemployment and the property bubble, as well as declining demographic trends, have made it a challenging emergence for them. We'll touch on how we are adjusting our portfolio for this risk. Developed markets have positive returns this year, but Europe is fighting their own battle against inflation, and the war in Ukraine continues. The bright spot has really been in the US, with the S&P 500 up over 13%. In particular, the technology-heavy NASDAQ is up over 25%, as many tech-focused companies ride the hype over artificial intelligence. The companies that I just referenced in the NASDAQ are concentrated in three sectors: communication services, information technology, and consumer discretionary. These sectors have posted the best returns through the third quarter, while the rest of the sectors have lagged. On the flip side, utilities has been the worst performer. Utility companies generally have strong cash flows and provide high dividends, relatively high dividends. But as bond yields have risen, bonds have become much more attractive, which has led to a sell-off for utilities. So 5 or 6 years ago, the market darlings were the FANG stocks. And today, that acronym has evolved into the Magnificent Seven. So Apple, Microsoft, Amazon, Alphabet, NVIDIA, Meta, and Tesla are all up 30 to 200%. And I should note that these stocks fell the most last year, so it's coming off of a low base. But combined, these companies make up over 30% of the S&P 500 and have accounted for most of the index performance this year. And this chart kind of further illustrates that point. The S&P 500 is a market cap weighted index, meaning that Apple's the largest company in the S&P. It makes up about 7% of the index. So Apple's performance accounts for about 7% of the index performance. If we instead look at an equal weighted index, where each company would account for 1/500th of the total performance, that index would be up only just under 2%, compared with the S&P's total return up over 13%. This really illustrates just how narrow the market has become, which is a concern moving forward. So one of the metrics that we track closely is the forward price to earnings ratio. This takes the price of the overall S&P 500 and divides it by forward estimated earnings. This chart goes back to 2000, when euphoria around the internet drove the PE ratio to 25 times forward earnings. When that bubble burst, the ratio dropped to the 25-year average of about 16. The great financial crisis was not actually a stock market bubble, but a real estate bubble caused by subprime mortgages. The ensuing stock market crash brought the PE ratio to a low of about 11 times earnings. The rally we saw in 2020 and 2021 was not supported by strong earnings and pushed this ratio to about 23 times, at which point stocks were looking pretty expensive. However, the decline we saw last year brought it back to the average of 16, and the rally we've seen this year has pushed it to about 18. So as a whole, the index is not a great deal, but not off the charts expensive. This chart portrays the S&P 500 year-over-year earnings growth and estimates. In 2020, the pandemic shutdown caused significant earnings declines, followed by a strong rebound in 2021. Earning estimates for this year were for a 1% decline, a relatively low bar to meet. And so far, company earnings have been mixed. Some companies have beat, others have faced challenges and cited headwinds. Next year, estimates are for an 11% increase, which would help justify that current valuation, but is rather optimistic. And with that, I'm going to pass it off to Darcy Smoot to discuss the economy.
Great, thank you, Evan. So one of the biggest, hottest debates right now is whether we're going to experience a soft landing in which the inflation comes down and we don't have a recession in the US, or a hard landing, which is inflation comes down, but kind of at the expense of a recession here in the US. So the first couple charts we're going to go through kind of support the soft landing argument, the idea that inflation is coming down and we're going to avoid a recession. So starting with inflation, from the peak, this chart is showing inflation going back to the 70s, and the headline number is in dark blue, core inflation is in gold. So headline inflation peaked at about 9% last year and has come down to about 3.7 at the last reading. Core inflation, which strips out food and energy, they tend to be very volatile categories. That's been a little bit trickier. So peaked about 6.5% and is at about 4.4 at this point. But in general, inflation is going lower. So that does kind of support the idea where we at least are going the right direction from an inflation standpoint. I should mention the Federal Reserve's target, kind of the ideal inflation number that they're going for is about 2%. So we're not quite there yet. And the question is how hard it will be to get there, but we're going the right direction so far. Looking at some of the drivers of inflation, energy you can see in orange on here, or brown, gold, I guess. Energy is volatile. So in the wake of the Russian invasion of Ukraine last year, we saw a supply side shock to energy prices. Oil was up to about $114 a barrel. It's come down since, so energy prices are not a driver of higher inflation. It's actually a negative impact to inflation lately. So kind of set that aside. Again, that's a very volatile category. But look at shelter, which is the dark blue bar here. Shelter as a weight in the consumer price index makes up the heaviest amount, and that makes sense. People tend to spend the majority of their earned dollars on their shelter. But it's not actually specifically rent or home prices. Shelter is mostly made up of owner's equivalent rent, which is a survey-based measure where people ask homeowners, what do you think you could rent your house out for? So in the early part of last year, shelter prices were rising. Those have started to recede a bit. So again, that is kind of going the right direction thus far. What I think will be more interesting and maybe a little bit stickier and more difficult to go lower are the things that are driven higher by higher labor costs. So restaurants, hotels, transportation. Overall, though, we've seen most of these categories go lower. So that supports the idea that inflation is moving the right direction. I mentioned the labor market, and it's kind of an interesting thing. You sort of want a Goldilocks labor market. You don't want to have, no jobs and a complete depression, because people not being employed is not good for the economy. On the other hand, you don't want to have a labor market that is so tight, especially right now, when inflation has been a problem, because that drives labor costs higher when you have an extremely tight labor market. The top chart here is total non-farm payroll, so total jobs in the US. And when the pandemic hit, we lost over 20 million jobs basically overnight with everything shutting down. It took time, but we recovered kind of back to pandemic levels, and have grown jobs above those pandemic levels since, but the growth rate is starting to level off here. Job openings on this bottom chart, this is an interesting story. Pre-pandemic, there were about 7.5 million job openings in the US. Of course, some of those were lost when the pandemic hit, but job openings exploded in the last couple of years to a high of about 12 million job openings. So that is really, I think, one of the reflections of the extremely tight labor market that the Federal Reserve was focused on to try to, they were encouraged to see some loosening, some reduction in those job openings lately, because again, that is a sign that their monetary tightening campaign to bring inflation lower is starting to work. This chart is another metric of the labor market in terms of the unemployment rate. Now, looking over the last 70 years, unemployment is extremely low at 3.8%. It's bounced off the bottom. If I were to zoom in here, you could kind of see it's bounced up a little bit, not too concerning levels. And the fact that I think it's risen a bit is mostly related to people who had exited the workforce starting to come back in. So the participation rate is starting to move a bit higher. But again, we're not at concerning levels where, you have 8% unemployment. That is where we've seen this unemployment rate during the depths of recessions, which are indicated in shaded lines on this chart. So we look very closely at the year-over-year change in that non-farm payroll number. So that from a few charts ago, the number that's starting to level off, we like to measure that on a year-over-year change basis. And the reason is, if we look at this chart is showing that year-over-year change going back to the 70s. And historically, we've seen whenever this year-over-year change in jobs dips to about the 1% level, a recession soon follows. So again, recessions are in these shaded blue areas here, and it's pretty consistent. When the pandemic hit, this metric honestly kind of broke. So we had a decline in jobs of almost 9%, followed by a year-over-year increase in total jobs of almost 6%. So it's not been terribly useful the last couple of years. However, as this starts to approach some level of normalization, this is going to be really important, and this is really something we're focused on. So if we start to see this metric get closer to that 1% level, we'll be probably a bit more concerned about an upcoming recession. The other data point that the soft landing camp might point to are delinquencies. So the rate of delinquencies on this chart is showing auto loans, credit card loans, and student loans. I'm going to put student loans aside for a minute. So just looking at auto and credit card loan delinquencies going back to about 2003. Now, when the pandemic hit, everybody was forced to sit at home and not spend money, and they received stimulus checks. So there was actually a dip in delinquencies at that point. Now, as things have reopened, people have started to spend, delinquencies have risen, but really not to concerning levels at this point. We're kind of just back to in line with pre-pandemic levels. So that's for auto and credit cards. So student loans, In March of 2020, the US Department of Education's Office of Federal Student Aid initiated temporary relief for student loans. So they suspended loan payments, stopped collection on defaulted loans, and reduced interest rates to 0. So student loan delinquencies have been not applicable by default, no pun intended, since about March of 2020. The other thing that you might say, hey, we're going to avoid a recession, is that the housing market is still pretty strong. This chart is showing the Case-Shiller Home Price Index in dark blue and the 30-year mortgage rate in gold. So starting with the home price index, home prices were rising at a healthy clip, and then the pandemic hit. People in apartments realized, hey, you know what? I've got all these excess savings from not spending. I can afford a down payment. I want more space. I want a home office. So home prices actually accelerated. So you see that inflection point basically right as the pandemic hit. When the Fed began its interest rate hike campaign last year, they raised rates very significantly, and not surprisingly, mortgage rates went much, much higher. So from a low of about 2.5%, mortgage rates rose to above 7%. As that happens, that of course makes homes relatively more expensive for anyone who needs to take out a mortgage to buy a home. So we did see a dip in housing prices, but at this point, it kind of feels like people are just used to higher mortgage rates. And so the home price index is starting to even recover back to its early 2022 levels. So now we get into some of the biggest headwinds that we see for the consumer and frankly for the economy as a whole. So why we might not see a soft landing. This is, I think, one of the biggest topics and one of the biggest hinging points for the economy. So looking at personal savings, we all know the story that consumers racked up a whole bunch of extra savings during the pandemic. This chart actually was put out by the Federal Reserve Bank of San Francisco during the Jackson Hole conference in August of this past summer. And what their research shown was that, yes, consumers accumulated excess savings to the tune of about $2.1 trillion during the pandemic. But in the months since things have reopened, consumers have drawn down much of that excess savings. So the SF Fed estimates that drawdowns have gone to the levels of about 1.9 trillion. So basically, long story short, consumers have about spent all those excess savings on, travel and goods and Taylor Swift tickets. So at this point, there's a hot debate right now about how much is there left to spend. But regardless, this is a headwind for the consumer. I mentioned the student loan payment pause a couple slides ago. They are now resuming. This is another headwind for consumers. So as of September 1st, interest on student loans went from 0 to whatever they were reset at prior to March of 2020. As of October, so this month actually, student loan borrowers now need to resume the payments that were paused for the last 3.5 years. So this affects 44 million people in the US. That's about 13% of the adult population. They've got an average monthly payment of about $500, and their average loan balance is about $30,000 for a total student debt outstanding amount of about $1.75 trillion. So people have had 3 years of not having to make this payments. $500 a month for a consumer that's going to eat into their discretionary budget as they begin making these payments again. The other factor that's kind of a inflationary driver, sort of a tax on the consumer, or it eats into discretionary budgets, are oil prices. So oil again has receded from those highs seen at the first half of last year. But in the recent months since the summer, Both crude oil prices, which are shown here in dark blue, and gasoline prices, which is kind of the most obvious impact to consumers, both have increased. So this is a volatile thing. It could go back down, especially if we see lower demand or a recession hit. But the longer that we see oil prices stay high, the more that can seep into inflation and impact the consumer. And then finally, this is the other topic that's been discussed by politicians especially, but in August of last year, the CHIPS Act and the Inflation Reduction Act were signed, both of which contributed to more domestic manufacturing. Of course, that's something that we've heard from both sides of the aisle. So, you know, there are, of course, reasons to do that from a lower geopolitical risk standpoint, you know, from a job standpoint, but it is generally more expensive to do that. So that also could be another inflationary driver that, again, does impact the consumer. So with consumption representing about 2/3 of GDP, this is really why we have all eyes on the consumer. So with that, I will turn it over to Steve. He'll talk about some of the fixed income things that we're watching as well.
Great, thanks, Darcy. And I'm finally happy to say that after talking about zero rates and low interest rates for many years now, we've entered a period where we're actually seeing some healthy real yields. In fact, rates are at their highest level in nearly 15 years. So it's a good time to be a bond investor. The graph we're looking at here takes a look at the U.S. Treasury yield curve, which gives us a visual snapshot of where bond market yields are for varying maturities. And the data that we're looking at in this chart compares where interest rates were at the end of 2021, represented by the blue line, to where rates are today, represented by the gold line. And if we look at the short end of the curve, you can look at 1 month or 6 month Treasury bills. They were yielding close to 0% in 21, and today they're well above 5%, actually closing in on 5.5%. So we've seen a significant increase in rates in a relatively short period of time. But what's also been interesting is that when the Fed started increasing rates back in March of 22, the long end of the curve, so the 10, the 20, 30-year bonds, they didn't move as much as the lower end. So we got what's called an inverted yield curve, where short rates are higher than long rates. And one of the reasons for that was the market just didn't believe that the Fed was going to raise rates as much as they have. And if they did raise rates, the market believed that something was going to break, and ultimately the Fed would have to come in and cut rates. So at the last Fed meeting in September, the central bank came out and confirmed their intent to keep rates higher for longer. And consequently, we've now seen the long end of the curve respond. At the end of June, the 30-year bond was yielding 3.85%. This morning, the 30 years yielding 4.95. So it's been a pretty significant move in a relatively short period of time. Next slide takes a look at the relationship between the 2-year and the 10-year Treasury. So this is something the market watches rather closely because it's been a good recession indicator over the years. In fact, every recession since World War II has been preceded by an inverted yield curve. So the spread went negative last year. It was down by a full percent this July, and the spread has narrowed to about 40 basis points or so this week. So typically, we don't see an inversion that's this deep or the spread remaining negative for this length of time. In fact, we have to go back to the early 80s to see something similar. This next slide takes a look at the high yield debt spreads, also known as junk bond spreads. So this gives us some insight to how lower quality, so really smaller or more risky companies are doing. This can be an indicator, just like the 2-10 spread. Sometimes it's referred to as the canary in the coal mine for recession that may be upon us. And when that happens, spreads will widen dramatically. So the high yield spread is the difference between the average yields of these lower quality assets and when compared to US Treasuries. And again, historically, when the market senses there's a change in the economic landscape or things are deteriorating, investors will start selling these more risky assets. And these spreads can widen from 10, 15, even 20% over Treasuries, which is what we saw during the pandemic. So with spreads today at 4%, the market it's signaling that it's not too concerned about a recession. And in fact, high yield bonds are actually outperforming US Treasuries this year, which seems somewhat perverse given the headwinds that Darcy just alluded to. And so this indicator is giving us a different signal than the 210 spread that we just talked about. So this graph shows the Fed funds target rate over the last 20 years. The Fed has a dual mandate to promote maximum employment and stable prices. And one of the tools it uses to fulfill those mandates is increasing or decreasing the Fed funds rate. So if we look at the current cycle we're in, the Fed has raised its benchmark rate from 0% up to about 5.5%. The market is pricing in, it's a small probability, but it is pricing in, there's a chance the Fed will increase rates by another quarter, 25 basis points or 0.25% between now and year end. And I think the Fed has 2 more meetings, one at the end of this month and then one in December. So we'll see what happens there. But it's also important to note the market is anticipating the Fed will need to start cutting rates sometime in 2024. So this is the ongoing debate. Again, Darcy referenced this in when we talking about inflation. Can the Fed orchestrate a soft landing? At the start of this year, more than 60% of economists and CFOs that were surveyed believed we would be in a recession in 23, and so far they've been wrong. So the Fed has continued to raise rates, inflation has slowed, and yet we've been able to avoid a recession. But the Fed's track record for soft landings has not been great. In fact, there's only been one time in modern history that they've been able to coordinate a successful landing, and that was in 1994. So in 94, as the chart shows, the Fed funds rates went from 3 to 6%. And although today our rates are at 5.5%, this cycle has been a lot steeper of a climb. And on a rate of change basis, it's been one of the fastest rate hike cycles that we've experienced. So we also need to remember there's a lag to monetary policy. So it's still unclear if the full impact of these rate hikes have been felt, or if they're still making their way through the economy. So for a long time leading up to the financial crisis in 2008, the Federal Reserve's balance sheet was about, or I'd say less than $1 trillion. And if you recall, in 2008, the Federal Reserve instituted quantitative easing to help shore up our US banking system, which was on the verge of collapse. And as a result, the Fed's balance sheet increased to about $2.5 trillion. And then, the Fed didn't really stop at that point. They kept injecting money into the economy. Balance sheet got up to about $4 trillion in 2017, and then 2018 they announced they would start reducing the balance sheet, which was met with some market resistance, and then the pandemic hit, and their balance sheet went from 3.5–4 trillion up to $9 trillion. Again, as the Fed injected liquidity, much needed liquidity at the time, into the markets. And then last year the Fed announced they would start quantitative tightening again, which basically means they're allowing treasuries and mortgage-backed securities to mature and roll off their balance sheet. So the Fed is walking a tightrope here, because in order to reduce its balance sheet, it means they can no longer be a buyer in the market. And that just means less liquidity. And ultimately, the Fed does want to ensure that the markets remain functional. So they've successfully reduced the balance sheet by $1 trillion so far, but they have a ways to go to get back to a more normalized balance sheet. So one of the consequences of rising interest rates has been unrealized losses on banks' balance sheets. The failures of Silicon Valley Bank and First Republic were tied in part to this issue. The banks at the time saw huge deposits coming in from their customers who were flush with cash. So they took that cash and they invested in long duration, mostly US Treasuries. So it wasn't a credit quality issue. The banks were not taking their customers' deposits and investing in risky assets. But because of the duration, when interest rates rose, the value of those bonds declined. And the large declines aren't necessarily a problem for banks because the accounting rules allow the banks to mark them as what's called held into maturity, which means the losses don't impact their profitability or their earnings unless they're forced to sell the bonds and to cover cash withdrawals. And this was what happened with Silicon Valley Bank. They saw a large request coming in for withdrawals. It was essentially a run on the bank. They were forced to sell the bonds and realize those losses. So today, most of the unrealized losses are held at the largest U.S. Financial banks. So think of B of A or Wells Fargo. It appears the market has a better understanding of what's going on and is not as concerned as it was back in March. But we are concerned, especially if we see higher interest rates. So if rates go higher from here, we think the spotlight will certainly be put back on the amount of unrealized losses on the banks. We don't think it's going to lead to a banking crisis, but you could certainly see some of the smaller banks, which are more sensitive to customer withdrawals, fail. So banks have tightened their lending standards. This is in part due to what we experienced in March with the bank failures, but also due just to increased economic uncertainty and concerns about deteriorating collateral values. So you think about what's going on in the commercial real estate market today. So as banks tighten their lending standards, the demand for loans will drop off, and this will cause a ripple effect and slow the economy, which again is what the Fed is trying to do, but they're also trying to make sure that it doesn't push us into a recession. So real interest rates, are rates that are adjusted for inflation, are now at their highest level in more than a decade. And this chart is from the Cleveland Fed, shows 10-year treasuries have real rates about 2%, and this was through the first half of this year. So if we update this chart through today, real rates for 10-year bonds are closer to 2.5%. In the shorter end of the curve, so 2-year treasuries are actually closer to 3%. And if we go back and look at history since the 1950s, real yields have averaged about 2%. So it means that bonds are attractive today. And for the last decade, we've been recommending to clients in their portfolios to overweight equities, which has been the right call because real rates were either at zero and there were periods of time where real rates and bonds were actually negative. But we think that's changing. And with real rates now positive, we think it makes sense to rethink those asset allocations and look to increase exposure to bonds in our portfolios. So with that, I'll pass it back over to Brooks, and he'll talk about some of the changes we're actually making in our portfolios.
Thanks, Steve. Thanks, Evan and Darcy. So what we've done in portfolios, essentially, we this quarter sold US Bank over concerns with their balance sheet, as Steve alluded, and reinvested those proceeds into JP Morgan, which is the biggest bank in the US and has not nearly the degree of interest rate sensitivity that most of the smaller regional banks have. Additionally, in the financial sector, we added to our position in Visa, has very strong profit margins, dominant market share, and with the consumer economy continuing to go, more and more payments are being done via credit card. We also bought Chubb, which gives us exposure to the insurance industry. Property casualty insurers have been under the gun with so many disasters, wildfires, hurricanes, floods, etc. And their valuations are quite low and quite attractive. In the technology area, we bought TE Connectivity, which gives us sort of a low valuation play on the electrical equipment industry as it's as an input to technology as a whole. We trimmed a VWO, which is a Vanguard ETF that's invested in emerging markets, in favor of another emerging market ETF that excludes China. And that's so that we reduce our exposure to China, given the country's significant problems in their debt market, especially in their real estate world. So, in summary, equity markets have been boosted by, positive earnings. We had a period of fear in the March period with first Silicon Valley Bank and then First Republic, followed by the uttering of those magic words, artificial intelligence, and that's created enthusiasm, especially for the Magnificent Seven. And most of them have gained back all, if not significantly more than they lost last year. The soft landing narrative, it's a debate. Nobody knows if the economy is going to turn into a recession or not. Recall in 1982, Paul Samuelson, who was an MIT professor, quipped that the stock market has correctly predicted 9 of the last 5 recessions. And so that, in fact, somewhat what it looks like was the bear market of 2022. The jury's out, but this has been the most aggressive rate hike cycle since the early 80s. We've seen a faster increase in interest rates in all prior periods up into as far back as Paul Volcker and what they did in the early 80s to break the back of inflation was to dramatically increase interest rates. So it hasn't really happened yet. We are concerned that the consumer is starting to pull back. We're seeing it very significantly in the lower demographic, the lower economic demographic, those retailers that are supplying goods to people who are very conscious of the prices are doing very poorly, whether it's Family Dollar stores or Macy's. Macy's is down 45% this year, as an example. So, and that could, if that continues into all demographics, that could be the harbinger of a recession to come. As Steve said earlier, after years of telling you Tina, there is no alternative. Well, now we have an alternative. And it's a very nice alternative with real yields at probably 20-year highs. So our focus is to look for attractively valued equities. We're not chasing performance. We're looking for defensive sectors and focusing on that in our portfolios, just in case that recession, which everybody thinks is not going to come, does in fact arrive. So with that, I'll turn it over to questions. And Darcy, I think you're going to moderate this.
Sure, yeah. So thank you, everybody. So if any of the attendees have a question, you can feel free to click on that Q&A box. We'll get to as many as we can and answer offline if questions pop up later. I'm going to start with a question for Brooks. There was a recent Wall Street Journal article about existing home sales data being at the worst level since the financial crisis. Why are home prices not weaker?
Great question. The reason that home prices aren't weaker is there's no supply. The supply of homes for sale in the non-new market is at all-time lows. Why? Because everybody refinanced their mortgages over the last few years, and selling their house to move to a different house means they're going to go out of a home with a 2.5% or 3% mortgage and into one with a 7.5% mortgage. So it's really supply. What's going on is the home builders are actually the only ones that are benefiting. And they're benefiting by buying down mortgages so that their customers can have more affordable payments. But there's a limit to how far that can go. And if rates continue to go higher, I think that the housing market will see some real problems.
Yeah, the supply, I think there's we've continued to see inventory challenges, or low inventory is one of those secular trends that's been trending lower for years, if not decades. And I remember an interesting statistic about the number of home builders in the US. It was somewhere around 100,000 in 2007. And today it's closer to 40,000 independent home builders. So I think a lot of them said, I'm not doing this anymore after the financial crisis and the home prices imploded. So I think that's also probably contributing to that low inventory. Okay, let's see, next question here. With unemployment below 4%, why do you think we could see a hard landing? So Evan, do you want to take this one?
Yeah, and again, great question. And I don't think we're necessarily saying that the hard landing is a foregone conclusion. But over the summer, it seems like most economists have a soft landing as their base case. And we may be a little bit more skeptical. So Darcy mentioned that 2/3 of GDP is consumer spending. And so far we've had a really resilient labor market. So people can get jobs, they can continue to spend. However, if that starts to turn, and if some of these other headwinds we mentioned, like student loan payments restarting, higher oil prices, higher interest on mortgages, new mortgages, cars, and other personal loans, that could materialize into a recession, and we could see that hard landing.
Great. Let's see, how about Steve, do you want to take this one? How do you reconcile the strong retail sales numbers that we got today?
Yeah, which came in higher than expected. And I think what we've learned over the years that it's really hard to change people's spending habits or patterns. Consumers have been flush with cash over the last few years, and they've been spending, right? They spent through the pandemic when they were at home buying household appliances, remodeling their homes, improving their backyards. And then as the pandemic ended, now they're spending on experiences, travel, and concerts. There was an article in the Wall Street Journal today talking about the high costs of concert tickets. And I think if we reflect back to the financial crisis in 2008 and 2009, if you recall, unemployment was 10%, housing prices were falling, the stock market was falling, and we were convinced that those experiences were going to alter people's spending patterns, much like what happened during the Great Depression. And we held shares of American Express. I remember the debate we were having, and we said, look, spending patterns they're going to change, and we ended up selling our shares of American Express, and we were wrong. The consumer just kept spending through that period of time. So we don't think this is an inflection point. We highlighted some of the headwinds for consumers, things like higher borrowing costs, student debt repayments. Those will all provide headwinds, and especially for the lower income earners. So we think it will have an impact on spending on the margin, but we don't see consumer spending collapsing given the current environment.
Yeah. I can take this one. The question is, how do you view the conflict in the Middle East in terms of investing? I think that this is obviously a completely horrific tragedy with casualties that are just absolutely atrocious. The market, though, in terms of the investing in the markets, the market has a pretty long history of shrugging off geopolitical conflict, no matter how awful it is. I think, when on last Monday morning, I was personally a bit surprised to see the market up as much as it was, the stock market, if only because I think these events can tend to have, whether it's like an emotional anxiety effect on markets, and there is sometimes like an initial down reaction, but markets were up on Monday morning after the news broke over the weekend. So I guess I was a bit surprised by that, but it is sort of the latest example of the market tending to shrug that off. I think the caveat is that if this spreads and becomes a broader conflict that pulls in more countries, I think that the biggest obvious impact would be another supply side shock to oil prices. So again, that's something we mentioned as a concern from an inflationary standpoint, as a consumer headwind. So that would be something that we'd be watching closely. But at this point, I think it's mostly a human tragedy. Okay, so we've got one more question here. Why don't you own more of the Magnificent Seven stocks? Brooks, do you want to take this one?
Or just as I said earlier, those stocks have just recovered all of the losses. Actually, the large growth stocks sector was down 29% in 2022, and it's up 24% this year. So we own a good sample of them. We own, Amazon. We own Alphabet. We own Microsoft. But chasing after NVIDIA or anything like that at this point with valuations in the stratosphere, I think is a recipe for disaster if in fact we see a hard landing coming about. The things that have been long looked at by us for signs that we're about to enter recession are really right on the edge. We could see, probably not this year, but early next year, the growth of non-farm payrolls could easily descend into that 1% level. We've had an inverted yield curve for more than a year. It's been a very, very, very large inversion. And at the point where that inversion ends, that's the point where usually a recession will start. So not saying it's going to, but we're taking a cautious stance as a consequence.
Yeah, and I would just add to that, it's a level of idiosyncratic risk that we're not super comfortable with. So idiosyncratic risk is basically the risk that one particular thing happens to one particular company that creates a downturn. Evan mentioned that the Magnificent Seven was 30%, right, of the S&P 500.
Yeah,
so you could imagine a scenario where there's some catastrophe at one of those companies, and that has a disproportionate impact on someone's overall portfolio. So, but it's also, I think, mostly managing that idiosyncratic risk. Okay, so let's do one more. What are the indicators that you're watching to see whether we have a hard or soft landing? Does anyone? I'll leave it up for grabs. Steve, or I can take it too if anybody wants.
Yeah, I mean, I think with the title of the presentation, the consumer, right? So that's been the kind of the lead indicator we've been watching. I think along with some of the metrics we talked about in the fixed income markets with spreads. We're trying to look into the crystal ball to see what's coming down the road. The 210 spread with its negative correlation or negative spread today, I think that's probably the biggest leading indicator for us that we are headed for a slowdown. But we're also getting conflicting reports from other parts of the fixed income market that says, yes, we're slowing down, but it doesn't look like it's going to be a hard landing. Everything's kind of pointing in the direction of a soft landing. But we're always at least 6 months or 12 months away from a recession, and that's as the markets climb the wall of worry, we're always looking out to see what's out there, and oftentimes it's what the market isn't focused on that is what will cause the shock that will send us into a recession. So we talked about some of the things we're looking at and watching closely. But we're also trying to figure out if there's anything else out there that we're not focused on at the present time.
Yeah, I think a lot of the charts in there, even the ones that currently probably support a soft landing outcome, delinquencies, for example, if those, we're back to pre-pandemic levels, but if we move significantly higher than pre-pandemic levels, I think that would be concerning. The year-over-year growth in non-farm payrolls, I think we outlined that. If that starts dipping, below 1%, that's going to be concerning as well. And then, you know, Brooks mentioned the poor performance from a lot of the consumer companies that cater to like lower income categories. But I think we're parsing commentary from management at all consumer companies. So those are, it is definitely consumer focused, I would agree. All right. Well, I don't see any other questions, but we are of course happy to go into more depth here and answer questions that anyone has offline. So please feel free to reach out to us and ask those questions directly if they come up after the presentation ends. All right. Thank you, everybody.
Thank you.